Hello and welcome to Portfolio Matters Weekly Update Week 27. But before we get into it, Stuart Owen will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Thank you, Stuart. First of all, apologies for the delay in this week's podcast. It is summer and both Richard and I have a busy holiday schedule. Interested viewers can find details of the schedule on our Discord channel. And thank you for Joseph Huber for getting in touch and telling us off for being late. But we're at it now, Joseph. So anyway, once again, it was a very busy week in the markets. So going through the economic updates we have had during the week, we had various PMI numbers. So the China composite came in at 50.6 for June, which was down from 53.8 in May and well below expectations. So that adds to growing evidence that China is slowing down. Europe looks good. PMIs came in at 59.5 for June, which is up from May and slightly ahead of consensus. In the UK, it was 62.2 for June, the composite PMI, which is very good, although down from May, but above expectations. In the US, however, the PMIs in June were a big drop from May. So the US market composite PMI, so the composite PMIs are a mixture of the manufacturing and service sectors and aim to give a view of the whole economy. The composite PMI for June came in at 63.7, which is well down on 68.7 in May and slightly below expectations. But what really spooked the market this week was the ISM non-manufacturing PMIs, which missed expectations by a long way. So the June number came in at 60.1 compared to 64 in May and were well below consensus expectations of 63.5. And that caused a sell-off in the equity markets and a rush into government bonds. And government bond yields fell sharply. So price of government bonds went up and yields fell. We also had data on Chinese inflation rate, which was a subdued 1.1% in June, down from 1.3% in May. And there is little evidence of a spike in Chinese inflation. We also had the US jobs report for May, which continued to show steady progress. So job openings were 9.2 million, up slightly from April, but below consensus expectations of 9.3. And in other matters, we had the UK balance of trade numbers for May, which amazingly, and one of the few occasions in my lifetime when this has occurred, the UK balance of trade was actually positive, as we're all banned from going on holiday and spending our sterling in overseas. Now, the other thing that happened this week was the OPEC meeting fell apart without agreement. And initially, the market took this as evidence that there was going to be no extra oil barrels onto the market and therefore was bullish for crude. And initially the crude price shot up. However, the market then went away and thought about it and decided this was evidence that OPEC may be falling apart. And in the subsequent couple of days, the oil price took a big knock. So going through some charts. Well, the main event of the week was the spike in US government bonds and the fall in yields. And so people have rushed to safety, and you can see that US 10-year yields are coming off again, although they did rise yesterday as equity prices recovered. But essentially, investors are cautious. And all that is evidence that investors are losing confidence in the strength of the recovery. They increasingly feel that the recovery is going to be weak and that economic growth may already have peaked in the US. So in China, unfortunately, Chinese PMIs are also weakening. However, Europe is looking good. European PMIs are now above their peak in the last cycle as Europe starts to reopen. And UK PMIs are also looking good as the UK heads for full reopening in a couple of weeks' time. As we've discussed, US PMIs, unfortunately, are coming off. And this is the number that really spooked the market, the ISM numbers, which were much weaker than expected and seem to show that the US economic growth impulse was fading. But US job openings remain strong. And as we have discussed in previous weeklies, one of the reasons that US companies are reporting poor conditions are because of supply chain difficulties and a struggle to find labor. So there are plenty of job openings, but US companies are struggling to fill those positions. And this is the UK balance of trade, which only does well when the economy is locked down for some reason. So at all other times, overseas expenditure is more than our earnings. Okay, on to other charts. And we're privileged this week to have with us Stuart Owen, an old friend of the podcast, who will be sharing some of his own interests. So, Stuart.
Viewers may remember that on previous editions of the show, I've mentioned my perspective on markets is to look for long-term equity return forecasts and make adjustments to my portfolio based on that. And I've previously highlighted forecasts derived from GMO. Jeremy Grantham is in the news quite a bit, talking about just how everything is in a bubble. But I thought I'd try and cast around and look at other analysts' views of forecast equity returns. And here I'm displaying some numbers from research affiliates, which do very good long-term work on valuation. And here they do a scatter plot where the x-axis is volatility and the y-axis is expected returns. And you can see that by and large, expected returns for equities under their model are pretty weak, especially in the US. The only area they deem reasonably attractive is emerging markets, which does also tie in with GMO's perspective. So this is my sort of top-down perspective, which I've been reviewing at the end of the quarter to make any portfolio changes. And it reinforces to me a cautious approach to markets, particularly equity markets at the moment.
What I take away from this chart, Stuart, is that the expected returns for equities are both low and highly volatile, which is not a very good combination for investors.
The trouble, of course, is that the same, if not worse, applies to fixed income, hence the corner that we're all pushed into. Now, this is another cut on the same issue. This comes from Hussman Advisors, who, again, also do very detailed work on valuation and long-term returns. Now, here they're looking at a version of a price to earnings ratio, where they're looking at the non-financial market capitalization within the US economy compared to the gross value added of those individual of the market at a particular data point. So here we can see that as the PE, or in this case, non-financial market cap over gross value added, goes up, so the subsequent returns on the S&P go down, and it's a pretty good relationship. So to me, that this reinforces the strategic point, which is that equities are very expensive. There may be no other game in town, and that's the problem.
Yes, first of all, thank you to our Discord member, Ali Baroid, for sending us this chart. And what it shows is that if this relationship holds, then the expected future return of US equities is quite strongly negative over the next 12 years.
And in my review of market levels, I've been looking at a few alternative measures, and here is the TED spread. Now, this is something that got a lot of interest during the financial crisis because it measures the riskiness of interbank lending versus government bonds. So you can see during that 08-09, banks had to pay an extra 3 percentage points compared to government bonds, reflecting that the credit risk in banks. And you can also see on the far right of the chart that spiked up to about 1.4% during the COVID crash, but now is at historically very low levels, even lower than during the fairly calm normal 90s. So again, everything is priced for perfection. Another very direct measure of exuberance in markets is the junk bond spread, i.e. How much extra junk rated companies have to pay compared to government bonds. And here you can see, of course, a massive spike last year where junk rated companies had to pay 11% more on average than government bonds. Now that's down to 3%. And again, very low compared to history. Again, a reflection of how highly priced everything is. And here's another way of looking at nervousness in markets. But this indicates that people are beginning to get a little bit cautious, a little bit worried about all these high valuation levels, because this is the skew index, which measures the difference in implied volatility between put and call options. And you can see that having risen to unprecedentedly high levels, people are paying up for put protection. My review of markets and asset prices, one of the things which really struck me was just how expensive index-linked bonds are. What we all know, fixed income has been pushed up, but my goodness, this chart shows a huge outperformance of index-linked bonds, which has, of course, resulted in very low real yields. This is the 10-year constant maturity TIPS yield, now down at -1%. So you're locking yourself in to get that inflation protection at unprecedentedly expensive levels.
Essentially, what this is saying is investors are really willing to pay up for safety, the safety of government bonds, and yet they're willing to accept losing a guaranteed 1% per annum in real terms ad infinitum.
And continuing the theme of the everything bubble, this is the price of the iShares US dollar corporate bond ETF. So we can see that the price collapsed enormously during the COVID crash as everyone was desperate for cash, collapsing from about $128 per unit down to 102 last March, April, but is now back to almost 130. Yields down, price up, but it's also, I think, a reflection of what can happen during a crisis, during a crash, where people are desperate for cash and will sell anything, even something reasonably sensible and safe. So to me, this raises the possibility of holding a cash buffer in the expectation that if everything is priced for perfection, then what you want to do is provide yourself with a rainy day basket.
Yeah, this recent recovery shows that investors are not believing in the inflation narrative. They think that the current inflationary impulse will fade and we'll go back to a deflationary or low inflation environment.
And extending the analysis from equities and bonds, I've also been looking a bit at real estate. And here's a chart of the iShares US real estate ETF. You can see, again, of course, the COVID crash, where the price of the units fell from $100 to 65. And they're now more than recovered that, and they're at 105. And this in an area of the market where you would think that there would be genuine fundamental concerns that the underlying need for real estate has changed. But the money's got to be somewhere, and it's pumping up this asset class as well.
Absolutely. Well, obviously, the cost of speculating in real estate is a function of corporate bonds and bond yields. And one of the charts I came across during the week was showing that for US mortgage holders, their cost of buying a house was the lowest it's ever been because of very low mortgage rates. And of course, all that just pumps up house prices.
I mean, this real estate ETF, just to be clear for viewers, does cover all US REITs. So this will include a lot of offices as well.
Right. And of course, we're unsure how much office utilization will fall when the economy normalizes and people can go back to work, but will almost certainly choose to be doing a certain portion of the week remotely. Okay, moving on to GDP. Well, this is the Goldman Sachs forecast for US GDP, and it is showing that they're expecting growth to fade back to its pre-COVID norms of, quite poor growth levels, about 1.5% within a couple of years. So we're actually within 18 months.
Well, of course, one of the big issues for the Fed is not just the level of output, but the level of employment. Arguably, it's the main issue now rather than inflation. So here's another take on the employment situation in the US. Instead of looking at the unemployment rate, which has recovered a long way back to its pre-COVID level, this zooms out and looks at the labour force participation rate. So how much of the labour force is actually working. And we can see that of course, it crashed during the COVID crash last year. It had a sharp bounce, but then has been moving sideways and is at an appreciably lower level than in 2019 and the pre-COVID situation. So this suggests, again, that there's quite a lot of people out there either choosing not to work or whose skills don't match the job openings.
Yeah, absolutely. And if you think about GDP growth, GDP is a function of labor, capital, and productivity. And if you're having low labor growth, well, actually in this case, the workforce participation is falling, and we know that the size of the labor force is not growing very much, then you're going to struggle to generate GDP growth if your labor participation rate is falling. Now, this is a great chart, which was sent again by Ali Baroid, who's one of our Discord members, and it shows the massive difference between US employment and US retail sales. So currently, the high retail sales figures are being supported by government largesse in the form of stimmy checks, and presumably this is unsustainable unless we get people back into work. Right now, it looks like Goldman Sachs have a point that this is unsustainable and it can't continue, and that GDP growth will fade. Okay, now, one thing I wanted to talk about this week was last week we touched on stagflation, and Richard was talking about how one of the outcomes he saw was a return to 1970 stagflation. Now, Richard, unfortunately, is not here to defend himself, but I'm going to push back on that because I don't think we can have stagflation. And the reason I don't think we can have stagflation is that the difference between now and the 1970s is that we have vastly more debt, and also we have independent central banks with an inflation mandate. So this is the history of US inflation and treasury bonds. And you can see, so the red line is the treasury bond yield, and the blue line is inflation. And you see that until recently, US treasuries had a positive real yield, and they had a positive real yield throughout much of the 1970s. So here again, you see we have dipped into the 30-year, now is negative, has a negative real yield. But since the 1970s, there's been an enormous increase in federal debt. So as a percentage of GDP, it has gone up something like 3 or 4-fold. And corporate debt has also risen strongly, up from around, what is that, 35% to above 50%. And household debt has also risen, practically doubling, although it is well down from its highs prior to the GFC. Now, all of that means the rise in indebtedness in the US makes it increasingly sensitive to rises in interest rates. And if we were to get stagflation, then you would expect bond yields to rise and the cost of servicing that debt to rise. And that would suck demand out of the economy and send it into recession. So I'm going to push back on stagflation. And I think what you get instead is volatility. The moment inflation rises and bond yield rises, then the cost of debt rises. And because of the massive debt burden, the economy goes into recession. You get bouncing oscillations, volatility. Now, these are some interesting charts from Nordea, which break down the recent rise in US inflation. And they add to the picture of recent high inflation being transitory, because if you look at the breakdown of inflation over the last couple of months, most of it comes from this blue area of the chart, and that is used cars. So used car prices have risen strongly and they've driven up inflation. The other contributor is the tan bar, and that is car rental. So car rentals and used cars have pushed up inflation. But apart from that, there really hasn't been very much. And historically, rent has been a big contributor to inflation. And recently, rent has not really contributed much to inflation. You see here, rent of shelter has actually fallen, but it's linked to house prices. House prices are rising strongly. And as a result, economists are expecting rents to start rising and that to push inflation back up. Now, briefly returning to used vehicle prices, it looks like they're peaked. And so that component of inflation should come down again. Previously, we have talked about inflation going back to the monetary formula. So PQ equals MV, price times quantity equals money times velocity. And we know during COVID that the quantity of money, M, went up by about 30%. So in order for there to be no inflation, the velocity of money has to fall by 30%. And what this chart shows is that actually banks just aren't lending to businesses. The orange line here shows the absolute level of loans, commercial and industrial loans, and outside of the government-supported COVID loan schemes, banks have actually not been lending at all, which does support a collapse in the velocity of money. You know, the banks create money by lending it out to businesses and individuals. And if they're not lending it out, then the velocity of money is going to keep on contracting. And this is the volatility indices. VIX is equity volatility and MOVE is bond volatility. And it shows even after this week where there was quite a lot of volatility, both remain subdued. So investors are complacent about the risks, I'd say. Stuart.
Right, here's something completely different. This is something I cribbed from Paul Krugman at the New York Times. This is looking at happiness and money. And so we have on the x-axis GDP per capita, the y-axis self-reported life satisfaction, scaled 0 to 10. And what we can see is there is some relationship. I think most psychologists would say that's to be expected. You need a certain amount of money to cover the necessities of life. But I think Krugen's article was pointing out that you could be the United States, very rich and at 7 out of 10 on happiness, or you could be only moderately rich, much more middle income like Costa Rica, and have the same, if not a bit higher, life satisfaction. And it all depends on the social contract that exists within the country. The assumptions we make, the connections that we have with people. And he was also pointing out the cluster of Scandinavian countries, which again are less rich, but more happy. So I thought this was a useful thing for all of us out there in markets trying to make some money to think about what actually gives satisfaction.
Absolutely. Well, this is very interesting. We should all move to Costa Rica, seemed to be the implication.
Well, I think they ditched their army and they put it all into the health service, didn't they? And it seems to be working for them.
Very good. Okay, on to the checklist. Well, the bold numbers, I think, hide quite a lot of detail this week because the all share was up 0.2%. The S&P 500 was up 1.4%, but we know that they dipped and then came back. NASDAQ up 1.5%, Topics down 1.4%, Bitcoin up 0.7%, and sterling flat up 0.1% against the US dollar. So this is the FTSE 100, and you can see that it dipped very strongly on Friday and then has bounced back. So dipped very strongly on Thursday and then bounced back on Friday to leave it actually slightly up on the week, but a volatile week. Stuart.
Yeah, my quarterly reviews, one thing I try to do is just to get a broad sense of whether particular currencies are expensive or cheap. So what I'm displaying here in the red line is the pound-euro exchange rate, so currently at about 118. And then I try to compare that to some guesstimate of fundamental value, which is the purchasing power parity estimate from the OECD. And what struck me is that PPP estimate is now basically 1-to-1. I'm used to thinking of the euro as being a cheaper unit than the pound, but on fair value, they would say it's about 1-to-1. So at the moment, the pound is strong. Now is a good time to spend your money on euros. Another cross rate that I looked at was again the euro, but euro against the US dollar. And we can see again in the blue line a fairly steady uptrend in the OECD's PPP estimate, i.e. Inflation in the States is more than inflation in Europe, and hence you would expect to be able to, over time, buy more dollars per euro. And I think this stresses again that fundamentally the euro looks cheap and is presumably staying cheap because of fears of another euro crisis, given the composition and structure of how the euro is being put together.
I completely agree with you, Stuart, but I also think that the fractures in the Eurozone are being held together by the ECB spending lots of money through its QE scheme. I mean, we saw that last year, essentially the ECB bought all Italian bonds issued last year. And as long as that continues, everyone's happy. But I don't think it can continue forever. And then, let's see. This is data from Bank of America, which shows that in the first half of this year, more money flowed into global equities than at any other time. So is this sustainable, we ask ourselves?
Well, Keith, these flow data, they always intrigue me because if someone's buying, then they are buying it from someone who's selling. So why isn't the flow zero?
Well, we have seen an enormous number of IPOs, I'd say, but you're absolutely right. Somebody also has to be selling. And frankly, this data does contradict some of the other data we've seen. So, the question is how are they calculating this? Now, this is a very interesting chart, and this shows the forecast or the intended QE program from the Fed. So currently, the Fed are continuing to buy $120 billion worth of treasuries every month until January next year. But if the economy, US GDP growth impulse fades, then frankly, I expect them to keep on doing QE. So, watch this space. But what this shows is there's a lot more money coming out of the Fed, and that's going to have to go somewhere, presumably into equity markets. So, and while Richard's away, we can have a go at Bitcoin. So this is the chart of Bitcoin.
Yeah, well, as Keith pointed out in the table, Bitcoin actually hadn't done anything during the week. But just out of curiosity, I thought I'd do a longer term chart. And here's one which came from Coinbase. And you can see that their default presentation of Bitcoin prices by the hour. I'm a bit more long term about things. So I brought up the data since 2014. And it's such a pity Richard isn't here, because isn't that a head and shoulders on the right? Doesn't that indicate next stop is 10,000 for Bitcoin?
Yeah. Well, I've known nothing about technical analysis, Stuart, but, I think in retrospect, you can draw whatever pattern you like on it. And anyway.
Yeah,
but
I'm with you.
One of the things that I thought was quite interesting this week was this chart from actually, I think, the Visual Capitalist, which shows the relative cost of mining one Bitcoin and the equivalent value of gold. And it turns out that you can dig down into the earth, extract the gold, smelt it, etc., and still it's much less carbon intensive than mining a Bitcoin. In fact, mining a Bitcoin is 15 times more carbon intensive than mining the equivalent amount of gold. And to put this in perspective, if your car did 24.9 miles to the gallon, you would have to drive 1.2 million miles to generate the same amount of CO2 as it takes to generate one Bitcoin, which I thought was an absolutely astonishing number. Anyway, those millennials, eh? So on to industrial commodities. And the thing I found really interesting this week was how most of the industrial commodities were completely unaffected by the volatility in equity and bond markets. So aluminium was down 2.1%, but it hovers near its highs. Cobalt continued to recover strongly, up 4.1%. Copper is stable, rising 0.6% on the week. Chromium was flat. Iron ore continues strong, up 1.2%. Lithium was flat. Neodymium has started to recover, up 1.3%. Nickel, again strong, up 1.2%. Ferrovanadium, which has had a very strong run recently, was down 4.7%, and that is the big faller this week. Crude oil had a very volatile week, but at the end of it was only down 0.4%. And we'll do more on crude in a second. Coal continued to be amazingly strong, up 5.6% on the week, and uranium was up 0.5%. So going through a few of the charts. Well, the first thing to say is that, as we covered initially, there's growing evidence that China is slowing, and slowing China should be bad for commodities. So that is something to be aware of. Perhaps it's time to trim the commodities bet. And one commodity we don't cover, but came to my attention, was gas. Now, Russia have actually been reducing the amount of gas they are making available to the West. And this apparently is to put pressure on European governments to approve Nord Stream, the second pipeline from Russia. And as a result, European gas prices are rising strongly. And this is before winter, and they're talking about actually supply deficits this winter. But when we talk about fossil fuels, this is a very interesting chart from the Visual Capitalist, and it shows the cost of generating electricity from various different sources. And you will see that over the last 11 years, so between 2009 and 2020, the price of solar PV collapsed. It was then, in 2009, it was the most expensive form of power generation and is now the cheapest. And wind power is now the second cheapest. So this is all actually very positive for the energy transition. It shows that going forwards, cheapest form of generating power is the renewables. So hopefully you'll see no more coal plants, even in China, if they get their act together. Now, occasionally we talk about food price inflation, and this week we had the latest data from the UN Food and Agricultural Organization, and it's good news. So food price index actually fell, and that was driven by vegetable oils and cereals coming off. But food price inflation this year remains strong. And as we've talked about previously in other weeklies, high food price inflation has led to social unrest in poorer countries where people spend a large portion of their budget on food. So something to be aware of. Okay, quickly going through some charts. Aluminium remains strong. Cobalt is recovering towards its highs. Copper is off, but is actually stabilizing. And during this week's shenanigans in the equity market, it remains strong. Crude oil had a volatile week, but in the US, we are seeing consistent inventory draws every week now. And US inventories are now below their 5-year average and falling. And I've heard commentary that August, which is peak of the driving season, will lead to very strong inventory drawdowns in the US. And unless OPEC gets its act together and starts increasing production, you could see big rises in the oil price. Now, the reason for all the OPEC squabbling was that the UAE, United Arab Emirates, is arguing for a bigger allocation in any increase in output. And this chart shows why. This is from John Kemp at Reuters, and it shows that the UAE actually cut its output more than either Russia or Saudi Arabia as part of the OPEC agreement in October 2019. And now it wants to increase production, and it thinks its cuts are too high. I am strongly assuming that they will get their act together over the coming weeks. And this is inventory drawdowns in the US, and you will see from June last year, we have had consistent drawdowns. That can't carry on. This is coal. Amazing. Another amazing week. Coal is really strong. Iron ore refuses to come down. Neodymium, having come down from the peaks, actually has had a good week and was up strongly. Nickel, where I've read a lot of commentaries saying that actually the nickel market is in surplus and will be in surplus for the next few years. But again, the price has been strong. Ferrovanadium, however, seems to have peaked for now. Okay, moving on to precious metals. Well, government bonds had a good week, so yields fell, and that is good for precious metals. Gold was up 2.1%, silver was up 0.4%, platinum was up 2%. The big anomaly was rhodium, which resumed strong falls, down 12.4%. Palladium was up 1.2%. This is gold, it's recovering. Silver is stable. Platinum has come off but is recovering again. Rhodium is the big faller. Now, you remember the rhodium is the best catalyst for breaking down nitrous oxides into nitrogen and oxygen. And the EU has mandated better NOx standards starting in September this year. So car makers were scrambling for rhodium earlier in the year, but it seems like speculators got a bit ahead of themselves, and it is now down 50% from the peak. Palladium, on the other hand, has recovered from its sell-off. Moving on to rates. Stuart.
Well, unsurprisingly, no change in UK base rate, still at 0.1%. And in effect, no change in US Fed funds, at just 8 basis points, up a little bit from 6 basis points last week, but still very, very low numbers. And as we've been covering it on other slides, the UK yields falling just the same as the US have done. So just taking as one example, UK 10-year now at 66 basis points, just phenomenally low levels from any sort of long-term investment perspective. But there we are. That's what QE can do for you.
Yeah. And this is UK 30-year yield. In absolute terms, people are willing to buy UK 30-year gilts at a rate of 1.17%. Yeah, absolutely amazing. And again, US 10-year yield has had, so US bonds had a strong week. Investors are increasingly nervous about the strength of the US recovery, but I think it's far too early to start getting nervous. One of the explanations I had during the week for the relative difficulty employers were having in recruiting staff was because of continued COVID disruption. So I was talking to actually my sister-in-law, who has 2 young children at school, and she was saying that they're getting sent home whenever anyone in the class has tested positive, or her son was sent home because he asked for a glass of water, and they took this as a sign he might have COVID, even though he had 2 negative COVID tests. And she was saying, if they didn't work from home, and they do, then they would find it impossible to go to work. So I think the after effects of COVID, until everything is fully opened up and people are not being sent home because of a positive test, because someone in the workplace has had it or whatever, will continue to be a drag on employment. Okay, let's move on to our weekly activities. Stuart.
Thanks very much, Keith. Yeah, I don't really work out a weekly performance number. It's not my investment philosophy, but year to date, 8.5%, which I'm very happy with, mostly down to all the yield compression that's been happening, which has driven up the price of various of my REITs and alternative investments producing income. Underlying that, of course, drip of portfolio income. I do like to receive a dividend in hand, so that's been coming through nicely. And actually some activity to report, which is not like me. Normally I'm sitting on my hands. And it's come to my attention that an IPO in the UK happening just as we speak of UK residential REIT. It's my sort of thing. This is going to be a modest size REIT, about 200 million market cap. That what they do is buy apartment blocks in non-London cities. So this could be Nottingham, Manchester, Bristol, Leeds, etc. They're buying a portfolio of apartments where they buy the overall apartment block on about a 5.8% yield. They then refurb these apartments and let them out on hopefully affordable rents. And so the offering is promising an initially 4% dividend yield, rising to 5.5% when the portfolio is fully invested. And thereafter, they're expecting rents to increase by asset management initiatives or just general earnings-related rent rises over time. So nothing exciting. This is not ferro aluminium resources. This is much stodgier, but hopefully something which could earn 5 to 7% a year. So I'm dipping my toe into that. As the disclaimer says, do your own research, but it's my sort of thing.
Very good. Well, that's actually a very good return for a half year, Stuart. 8.5%. And moving on to my own performance, you're doing much better than me, despite taking substantially less risk. So I came back from a week's walking in Snowdonia, frankly, expecting my portfolio to have taken a real hit because of the carnage in the oil markets. And I was pleasantly surprised to see I'd only lost 0.6%. But that takes me down to only up 6.1% on the year. So underperforming both Richard and Stuart, and also underperforming the all share. Now, I had a couple of limit orders hit during the week when I was away. I bought some Secure Trust Bank, which one of our Discord members had discussed. Now, during the summer, frankly, I'm afraid that we don't really have time to do any big dives into companies, and that our share talks on individual companies will return when the kids are back at school, probably. But in the midst, and I intend to cover Secure Trust Bank in the future. A brief summary is it's a UK bank that I've never heard of, market cap about 200 million, and it specializes in consumer credit. So motor vehicle loans, etc. And it looks quite cheap. And if you believe that consumer credit will return, demand for it will return, then it should do quite well. And I bought a bit more Valaris, which is a dodgy US oil services company, which has come out of receivership. Now, the one update we had during the week, and this is one of Portfolio Matters' success stories, because we covered it in Share Talk back in March when the share price was about 3p, and the share price is now 7.2p. And we liked it because it had an oil discovery in Mongolia. I can see that Stuart here is thinking this is exactly what I expect Keith to be doing. Tiny oil company in Mongolia. And it was awaiting the exploitation license, and it was saying the exploitation license would be approved by the end of last year. Well, this week we finally got it. However, it now needs $20 million to actually drill some wells. And given that nobody is investing in oil companies, frankly, I am concerned about what terms it will get that money. And it is looking to farm out part of the oil field. So the question is, how much is it going to have to give away to fund the development of that well, and also several exploration wells that it would like to drill? So watch this space. But we are seeing a number of rights issues from other oil companies, and it's going to reach that time in the cycle where companies which have had their balance sheets eroded during the bad times now looking to rebuild them. And I, for one, am having to sell some of my other companies to fund rights issues. And once again, this is the story of my portfolio's malaise. The blue line is Brent. The orange line is a UK oil company ETF. And you can see Brent has shot up. And once again this week, oil companies have done nothing at all. In fact, they're down on the week. So there you go.
That is rather staggering, given that Shell actually did increase their dividend.
Yeah, absolutely. Now, people are, for whatever reason, I think, buying into the narrative that of the energy transition and that oil prices are unsustainable. And what I do notice is that one of the things I read about during the week was how the explanation for the relative underperformance of oil companies was that if you looked at the oil price 5 years out, it was much lower than the spot price. And that is true. However, the price of oil 5 years out has actually risen very strongly over the last 6 months. And so you would have expected oil companies to do well, but they ain't. Anyway, I expect at some stage that will change.
Keith, I fear that there may be an effect here where the European companies like BP, Shell, etc., they're not showing quite the capital discipline that we would hope, whereas the more hard-headed Americans are running their companies for cash, knowing that, yes, this is coming around the corner, but they're more prepared to manage the decline for shareholders rather than use cash flows to grow for tomorrow.
Yes, I know. BP paying record amounts for wind acreage offshore. Yeah, I know. One of the concern is how much of investor capital they are squandering, and renewable energy projects they don't seem to have any expertise in anyway. So I think that is it for this week. Thank you very much to Stuart Owen for subbing in now when Richard is away. And thank you all for watching. And I hope you will press like and subscribe to our channel. You are welcome to join our Discord, where, amongst other things, you will find regular updates of when we are expecting to record various things, including the weekly update. In the meantime, it's goodbye from Stuart Owen.
And goodbye from Keith Jordan.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.